So we're going through chapter 2, IFIC exam. So this chapter 2 is about overview of the financial marketplace of Canada. So the overall, so we started talking about this overall, what is capital? Capital is any money which is used for investment purpose, right? And who provides that money? We as consumers, we save money in the bank, and that the bank uses that money and gives it out also for lenders and other purposes. And institutional investors also, they are sources of investment, sources of capital, and foreign investors. And the users who uses that money is businesses and individuals and also government. So we said that there's T-bills, Canada premium bonds, marketable bonds. These are, so any of these securities you see, they really, what are they? They are ways of getting capital. They, why do companies issue bonds? Because they want people to invest in the bonds and use that capital. And same thing, government also issues T-bills, premium bonds. These are all, the government uses those bonds as a way to get capital. So the government can use that money in their different, in the different, for example, infrastructure and everything. So we talked about these financial instruments. So there's debt instruments, which are fixed income. We said T-bills are issued by government, commercial paper, bonds, fixed income, debentures. The investment funds are your mutual funds, seg funds, ETFs. Those are all funds, right? And then there's shares, common and preferred shares, derivatives, and ETFs. So all these are ways that companies and governments, they issue these, and investors put their money into it with the hope that they will make a return on it. And the companies get to use that money for their business, and governments get to use that for their also work, right? So that is what a financial instrument is. So the markets, we said primary. If you're directly buying an investment from the company or from the government, and they are going to use your money, that is a primary market. That is a directly. It's also with stocks. It's known as the IPO, initial public offering. In the case of the secondary market, we have all the stock exchanges in Canada, right? So stock exchange, there, buyers and sellers will share between themselves the securities. They will trade the securities. So we talked about this. There's mainly, these are some of the main markets, the auction markets in Canada. There's Toronto Stock Exchange, TSX Ventures for new companies, Montreal Exchange is for mainly options and futures. So we talked about options and futures. They are mainly traded on Montreal Exchange, and also there's one in Winnipeg also. So those are mainly the financial markets. Those are auction markets. And a lot of the trades are done over the counter. Over the counter means they're not on the stock exchange. They are separate. They are done through dealers. So that is called over the market. It's also known as unlisted market. And there we have bond dealers, and some even equities are on this market. So I think we stopped here. So there are two types of institutions. One are non-deposit, other deposit-taking institutions. So the life insurance companies, they have a lot of deposits from the premium that people pay the premium. And so they are non-deposit taking institutions. They get the premiums and they use that premium and they invest the money. They have a lot of money available for investment. And then the depositing institutions are the banks and the trusts, right? So they are the ones which have savings, and they will also be a financial intermediary. Intermediary means it's between the buyers and the sellers. They are intermediaries. Other intermediaries, we have chartered banks, investment funds, credit unions, and some of these also other institutions. So the investment dealers, they are non-deposit taking institutions. They help to assist in the transfer of capital from savers to users. So the investment dealers, they are the ones who are mainly helping companies issue the security. So we read in chapter number, I think it was 11 or so, about how companies bring the securities to the market. So there's underwriting. So they are going to issue stocks or bonds, and the investment dealers help them. Investment dealers are basically companies, for example, TD Waterhouse, um, also BMO Nesbitt Burns, Scotia McLeod. These are like the investment dealers. They will help companies bring their investments to market. So SROs, we have two main SROs in Canada. One is MFDA, other is IROC. So MFD is Mutual Fund Dealer Association. So obviously from the name, they only deal with mutual funds. So some companies, they only have mutual funds. For example, RBC Mutual Funds, Scotia Mutual Funds. They're a company. They have their own company. They only deal with mutual funds. So the company is registered with the MFDA, and all the financial advisors in the branches, they also are registered with MFDA, right? So that is the purpose of MFDA, that it is only for mutual funds. IROC manages all the other types of activity. Okay, so IROC is going to manage all the other types of investments in Canada. So IROC actually includes mutual funds also. Some companies, for example, like I said, TD Waterhouse, they deal in all the types of investments: stocks, bonds, derivatives, mutual funds. So that company will be registered with IROC, and the investment advisors will be registered with IROC. So those investors, mutual fund dealers, which are registered, which have CSC, so they have to do Canadian Securities Course, which is part 1, part 2, and they have to do CPH. When they pass those 3 exams, they can become investment advisor for stocks and bonds, mutual funds, everything. So they are registered through IROC. Okay, so they will be going through IROC. So that is the objective there. So that's clear, the difference between MFD and IROC. Is that clear? Any question? Okay, good. So that's about it for chapter 2. Okay, so that's a regulatory organization there. Chapter 3 is about economics. So there's microeconomics and macroeconomics. Microeconomics, we're only looking at a small scale, the individual consumers, households, and producers. So we want to see how prices affect production and distribution of goods and services. So that is microeconomics. Macroeconomics is you want to see the whole economy as a whole. And so you look at the trends overall in the whole of the country, then you're looking at macroeconomics. For example, national income, business cycles, macro supply, demand, inflation, unemployment, monetary, fiscal policy, and balance of payments. So we'll talk about these here in the next slides in the macroeconomics. So the main decision makers in the economy are consumers, firms, and government. So people make decisions, am I going to save money or not? Firms make decisions, are they going to expand their business or not? Do they need more capital or not? And government also decides their infrastructure. Are they going to make more airports? Are they going to make more roads or highways or not? So they are the decision makers in the economy. So the law of demand and supply, what they're saying here is that overall, the price of as the price of the product rises, quantity demanded falls. So demand. So as we can see here, if the price of the product is $1,000, okay. So at $1,000, the demand is going to be very high. Demand is going to be for, actually it should be another on this side. Demand is going to be very high. Maybe they need 5,000 of those products. Okay. Now, if the price goes higher, price goes to 3,000. Now the demand is going to go down, right? So as the price of the product rises, the quantity demanded falls. So that's one thing We're saying here, yeah, this is the demand, yes. So see here at 3,000, right? The quantity demand is going to fall. And then the supply says that as the price of the product rises, the quantity supplied rises. So the more if there's 500 people demanding the product, or 500 products are being demanded, the supply company wants to supply more, right? Company wants to produce more if there's a more demand, right? But um, so the price, it goes opposite. So the law of supply is going to be going this way, and the law of demand goes this way, right? And then there's a point here which will be the equilibrium. So we're seeing here if the price is 1,000, so price is 1,000 here. If you draw a straight line across here, the demand is going to be for maybe 500, okay, and the supply is very low. If the price is 1,500, now if you draw a straight line here, the demand is maybe 350, it's going to be less, and the supply is maybe 100, right? And if the price is really high, 2,500, if you draw a straight line here, then you're saying 300 is the supply and 200 is the demand. So there's going to be mismatch. If there's more supply and less demand, you're going to have extra stuff in the store, people not buying it, and then they're going to mark down the price, or they're going to ship it back to the company. It's not sold, right? And if there's a lot of demand and there's not supply, that's also bad. Then people are going to be frustrated, and your buyers are going to look at other competitors, and so then that's not good either. So there's an equilibrium. So this equilibrium point is, what is the price? So at $2,000, the company is willing to supply 200 maybe a month, or 200 a week. So at that rate, it is feasible for the company, right? So they are able to fulfill that objective. And so in this way, the supply is going to be at an equilibrium. So this is just saying the same thing here. Now you might hear about the home prices or have gone up so high. It's all based on demand. If there's more demand, then it will affect the price. And so there will be a price where there's an equilibrium point, right? So this is the purpose here that we're talking about, the demand and supply curve. Any question on this? Sorry. Okay, so the gross domestic product, GDP, the GDP definition is the value of all goods and services which are produced within Canada's borders. And so the GDP can be measured using expenditure approach. What is the expenditure approach? GDP is equal to consumption plus I is investment plus G is government spending plus X minus M. X is exports, M is imports. Now think of it as, if you are exporting any item from Canada, money will flow in, right? So it is a positive thing for the company, for the country. If you are importing any item, you have to pay out the money. So then it's a minus, right? So so X minus M is the net exports. So that is one thing we look at overall. If there's more exports, it's good because more money is coming in, right? Um, G is government spending, so that is also has a value. C is consumption. By consumption, we mean retail, so all the sales. So of course, there's some money which is not recorded, which is cash payments. The money which is, for example, the value of taxi. If you go on a taxi and you pay in cash, it's not recorded, right? If you pay anybody in cash at a store, it's not recorded. But most everything else, 80-90%, is going to be recorded. Anything you pay with your debit card at a store or credit card, all that is recorded, right? So that is consumption. So the more there is consumption, it means the more things, there's more GDP, goods and services are being purchased, right? Expenditure approach, we're looking at spending. We're looking at how much are consumers spending, we're looking at how much is government spending, and the net exports, and whatever savings there are. These are all the expenditure approach. The other way to do it is an income approach. We're not going to go into detail, but income approach is basically you look at, for example, if you have any person, you ask him, what is your source of income? He's going to say, I have a salary, I have a business, I have a rental property. I have three sources of income. So his salary is 70,000, suppose his business is 20,000, 10,000 is his rental income. So he's got $100,000 income, right? So that's one way you can estimate what is his income. Other way is to say, okay, tell me all your bills. What are your expenses? So if he tells you, I pay the mortgage, I pay all these bills, I spend money on grocery, I spend money on these things. So if you add up all the expenses plus the saving that they did, that is the savings like investment. That is the expenditure approach. You're adding up all the expenses. So now you can get an idea what is the expenses of the person plus the investment. That should also equal the income. So the same way here, the government does both ways. They do calculation based on both of these, expenditure approach as well as the income approach. And this way, so if there's more people who are consuming the products, or there's more investment, or there's more government spending, then it means that overall our economy is growing. Then it means it's a positive thing, right? And so what is nominal GDP? Same thing we talked about. Remember, we talked about, I think, CPI, nominal CPI, and also the rate of return. We talked about nominal rate of return and real rate of return. Same thing here, GDP. For the real GDP, whatever the nominal GDP is, we minus inflation, and we get the real GDP. So if 1% is inflation, 5% is nominal GDP growth. We're talking about GDP growth here. If 5% there's a growth in the economy, right? But we minus 1% inflation, so the real GDP is going to be 4%. So the GDP gives an idea about the economy, overall economic growth. Is the economy growing, or is it stable, or is it decreasing, or what are the indicators? So this again, same thing, nominal is the goods and services in a year, and it takes into account inflation, the GDP, real GDP. So that's just, again, repeat. What are the reasons for GDP growth? There's population growth. So there's more people. If there's more people in an area, consumers, they will be there, good for, they're available there for doing the jobs. They will get income, they will spend money. So it's a cycle. So they should get income and they should spend money. Both things are there. So that grows the economy, because the more they spend, the more production needs to be produced, and the more the factories will run, and the more economy will grow, right? Other reasons for GDP growth is capital stock. So more savings, more money which is saved by the consumers. That is also capital stock. And more investments. That is also growing economy, because now money is available for growing the overall economy. And technological innovation. So technological innovation is also important for growth. Of course, now everything is computerized. If a country has a lot of resources but they don't have technological innovation, then their economy will not grow that much. So this is the business cycle. The business cycle says that overall the economy goes in cycles. It will go up and down like this. So there's a peak time where the economy is doing really good. Then there's contraction. So contraction is a reduction in the GDP. And then there's recovery. Recovery is the GDP is going back up to the previous peak. So as we see this line here, this was the previous peak. So this going up is called recovery. And when the economy goes over and above that limit, then it's known as expansion. So our economy is going over and above the limit we had there. So recovery and expansion are two different things. So you should be clear about that difference. Okay, clear? So in each of these, we need to know what is happening. In expansion, so this is expansion where the economy is growing. It is good, but not 100% perfect. There's stable inflation and the economy steadily expands. There's a lot of inventory levels and they meet the consumer demand. So there's enough inventory also available. There's rising corporate profits and stronger stock market activity. So so overall stock market is doing really good, and unemployment is going down. So overall expansion is good for the economy. Then we have a peak. The demand is going to be going so high that it reaches a certain stage where it's going to be over and above the capacity. So that's the peak is where, for example, if there's factories that are running 24/7 and they have a lot of production, and there may be labor shortage also. See rising wages. So because there's a lot of production, a lot of factories are running day and night. So like Tim Hortons, if they have to go 24/7, they need people to work at night. So they need also to pay the wages, hire more wages to get more people, and interest rates are going up. So that's a peak. So here, business sales decline. So at the peak, they start to slow down, and people start to stop buying stuff. So inventory levels go up. The stocks of items starts going up, and stock prices fall, and general market activity declines. So that is the peak. Contraction, we said, is where the level of activity declines, business postponed capital investments, and the profits go down. So consumers spend less and less, and they increase the savings. So contraction is where it is going to be a little bit at a slower rate, right, in the contraction, and consumers spend less, and they increase the saving. In the trough, the bond markets rallies as the rates begin to fall, and the consumers start spending again. So trough is where this low point, where the bond market is going to be is beginning to fall, and consumers start spending again. Under under recovery, GDP returns to its previous peak, and business investment rises. Unemployment may remain high, but inflation is set to fall further. So recovery is going to be there also. So obviously, we can see that it depends on overall unemployment, GDP, different levels, or different things happening in the business cycle. So from looking at the stock exchange, looking at overall growth of the economy, we can get an idea where we are in the stage also. So there's some leading indicators, there's some coincident. So leading indicators, they are going to go up and down before the market. So they are indicating overall where the business cycle is. So in your book, like they mentioned, housing starts. So example one is housing starts. So new homes, if they're built, it's a big investment. There's like, millions of dollars. A builder is investing. They buy the land, they get the permits, they make the homes, they sell the homes. So it takes 2, 3, 5 years for them to complete the whole project. And so it's a leading indicator because it's a long-term project, and it's a lot of investment. So the more there's new homes being built, the more there's going to be growth in the economy. And it means people have money to buy the new homes also. So that's why it's a leading indicator. And then when people are going to buy the homes, they will spend money to fix up the homes. So it grows the economy a lot. Each home, they say, contributes about $50,000-$60,000 to the economy also, because there's, of course, a lot of people get commission on it, and then there's banks also get a benefit, and then people go to the stores and they will invest in their house and all that. So that is all leading indicators. In the constant indicator, it helps determine which phase of the business cycle an economy is currently in, much the same way a thermometer determines the current. So current constant one. So the stock market is usually like that. It's a coincident one. It moves with the economy. Under lagging, we have those indicators which are going to change after the economy. An example of that is the unemployment. Unemployment is a so when the companies slow down in their production, they will not let go all of their people. They will just say, okay, hold on, let's see, maybe it's a temporary slowdown. They will wait, and then they will later on let people go off, right? Um, and the in our case, and then also, so that is like a lagging indicator, unemployment. And also, if the economy grows really fast, they will hire people, but very slowly. First, they may take, for example, other options. They may maybe people will not be. So if the companies are growing, so they need more people. They may hire co-op students. They may hire a contract, right? They won't hire full-time employees. Only later on, if they're sure that they need people, then they will hire more people, permanent, right? So so that is those are the economic indicators. Any questions so far?
We're good.
Okay, all right, and then so recession. Um, so Stat Canada, yes. So, so under Stat Canada, this is the definition of recession. So it must be significant and duration must be more than 2 quarters. By 2 quarters, we mean at least it should be for 6 months. So the duration is going to be more than two consecutive or quarters for 6 months. And it must be a feature of the whole economy. So overall, the whole economy would be slowing down. It's not like a temporary, it's not just some sectors, but all the sectors should slow down. And also employment and per capita income, that also, they look at that also, whether there's employment or unemployment, what is happening. So unemployment, yeah, this is important. So the unemployment, first of all, we need to understand there is, okay. So first of all, unemployment, we look at labor market. What is labor market? Labor market is this is people who are able to work. Labor market does not include those who are under age 15 and those who are retired, age 65. So the labor market is between age 15 and age 65. That is the labor market. So in that market, how many people are working? That's the participation rate. So the percentage of the working age population in the labor market or labor force. So we have, for example, some people are stay at home, they're not working. Some people are sick, they're not working. Some people are just too rich, they don't need to work, right? So they are not included in the working age. Okay, so the participation rate tells us overall how many people in the working age out of the labor force is working, right? Here, I think in Canada, it's like 40 to 50%, maybe 45%. Um, and unemployment rate is the percentage of the labor force unemployed. So the people who cannot find work in the labor force, that is the unemployment rate. So it's not in the whole population. So we don't look at everybody in Canada and calculate how many people are unemployed. It's only in the labor force. Those who are between 15-year age and 65, and those who are looking for work, those who are not sick, not retired, not those who are actually looking for work. That is the unemployment rate. So like these days, it's around 8%, and so that is the concept of the unemployment rate. So unemployment can be divided into three categories: structural, cyclical, and frictional. So let's talk about those three.
Yeah, sorry, and just to confirm, right? The unemployment rate, right? It as in the rate, it has to be people that are in the labor market but are not employed, meaning that a 70-year-old person cannot be in the unemployment rate.
That's right, yes. The unemployment rate only includes those which are between ages of 15 and 65, those who are not retired, not students.
Okay.
Yes, that's right.
But are unemployed, but are actually searching for jobs, right?
Yes, actively searching for jobs. Yes,
Okay. Okay.
that's right. Yes. Um, okay, so now the unemployment can be further divided into three categories. So we have structural, cyclical, and frictional. So no country in the world has 0% unemployment. There's always going to be some unemployment, right? So the unemployment is divided into three types of unemployment. There is cyclical. So cyclical is based on the business cycle, right? So overall, the business cycle is going to be: are we in the trough? Are we in the peak? Are we in the, what stage are we in the cyclical unemployment? So that is, if the market is going down, then we are going to be in a negative situation, right? We're going to be, obviously there will be some unemployment there if that is the situation. So frictional is labor turnover in normal healthy market. So that means that we overall are going to, um, that's normal. Every time there's going to be some people who leave on their own. They're not working anymore because they left. They don't want to work anymore, or they want to study now. Some people leave work because they want to study, right? They want to go back to school. Other people are going to be leaving because, so this is normal, and it's actually good for companies because companies need to have some people available all the time to hire, right? If everybody's employed, there's not going to be anybody to employ. So frictional unemployment is okay. Usually it's like 2, 3, 4%. That is like normal. Structural unemployment is due to changes in the economy, due to technology changes. Example of that is ATMs. ATMs in the banks now can do a lot of things. You can deposit your bill there. You can also, you can you can do a lot of transactions there on the ATMs, right? So people don't need to go to the tellers. So the need for the tellers is less because of that. And so then the tellers may get laid off or they have to find other jobs. So structural unemployment is due to changes in economy or technology, due to skills and training. People need to get more skilled or trained. So that is structural unemployment. Okay, let's go on. Next, we talk about interest rates. Actually, before we go to interest rates, I wanted to show you also, like this is, let me bring that up. So I want to show you the economic indicators for Canada. These you can see on the government website where we are in the economy. Okay, so since we're talking about the economic growth, so this website is statcan.gc.ca. So it is Statistics Canada. This is the Government of Canada website for the economy. Okay, so you can get an idea where we are. Now, these are the ones we talked about. Of course, population is important. 38 million is population, and very low growth because immigrants are not coming, and again, not much growth there. CPI, so this is your consumer price index, that is the inflation. Inflation is 3.4%, and as we can see, it's on an upward trend. So inflation is going up, right? It used to be 2%, 3%, and now it's 3.4%. And then unemployment rate, as you can see, is 8.1%. So again, this is out of the labor force only, right? Unemployment is a key indicator. More unemployment is and that again is unemployment is up zero point 0.6 points monthly change. The real GDP is also important to look at, and that is also up 1.4%, right? You can see here also, let's take a little bit more look at this GDP since we talked about it. Overall, we can see this is the impact of coronavirus, you can see. right? So the GDP in Canada, um, so billions of dollars, all industries. Yeah. So this is the real. So this is real GDP. It minus inflation. As we can see, was on an upward trend overall here, and then this is coronavirus happened and kaboom, it went down to here. And then since then, it's been going up, still better, but it's still not back even where it was before. So this gives you an idea about the GDP um, of Canada, right? Is that interesting? Good to know. So this here actually COVID-19, this gives a good idea about all the concept, what happened with COVID, right? So we can see here, I'm going to actually go to the, not the key, I'm going to go to the infographics. Okay, let's go back there to infographics. Okay, we can just take a look at the trends. I think let's look at the trends. Data tables, infographics, 1 year, okay. So over here, you can read about what is the impact of the coronavirus on the economy. But let's take a look at the overall unemployment rate, how it has changed. So over the time, you can see here that the third wave of pandemic leads to employment losses. In April, there's a loss in the employment rate also, right? And you can see the overall table here also. This shows you that so oh, actually, I want to show the graph. Where's the graph? Sorry, I can't find the graph. Where's the graphs? Let's take a look at the graphs. So, but it's good to check over here overall. Where is the the changes happening, right? Unemployment rate and okay, this is what I wanted to see. So unemployment, same thing as that. We saw it there. Unemployment. It also employment fell. Employment was here and it fell down with the economy. So as we can see, this is also a leading indicator of the economy, right? A lagging, sorry, lagging indicator. And then the yeah, so you can see all these other graphs. So this is gives unemployment ticks up during third wave. Third wave it went up and then it went down. So what I'm saying here is that overall these are the main indicators you need to know about. There's the of course population, there's CPI, there's unemployment, and there's real GDP. Okay, clear? Does that make it a little bit more clear?
Yeah.
Okay, so let's continue our discussion here. We're talking about interest rates. Okay, so in the interest rates, we said that there's different things. What is interest rate? It is important for business owners because it is a component of the cost of capital for production. It is the price of credit for consumption. Okay, that is the interest rate also. And so more interest rate means less people are going to invest in the, they're not going to buy so many things because the cost of borrowing is higher. So big ticket items are not going to be bought, like cars and fridges and appliances, right? So interest rates are going to be a key driving force for the economy. That's why you might have heard the government has reduced the interest rates because lower interest rates will stimulate the economy. So what affects interest rates? We have demand and supply of capital. So that's one thing. Default risk. If there's a large chance of companies going default, companies are going bankrupt, then the interest rate may be higher because their risk is higher. Banks are going to be increasing their rates for those if companies are starting to go bankrupt. Foreign developments, we have interest rates and exchange rates. So interest rates are also affected by US dollar and Canadian dollar exchange rates. Central bank activities, credibility. So here, some governments, their central bank is very, like you might have heard, like Greece has a lot of issues with their with their, for example, bonds. If the bank doesn't have the money to pay the interest, or they don't have money to um, pay the money back, so then the central bank is going to have a major impact on the overall interest rate. You might have heard even in the U.S. Do you guys know the government was shut down for a few days because the government didn't have funding for the interest payments also, right? So that is central bank activities, credibility, and then inflation is going to affect interest rates also. So we'll talk about these here. So interest rates are very important for the economy. Higher interest rates means that there will be more cost of capital, right? And if there's more cost of capital, businesses are not going to buy equipment, they're not going to buy other businesses, they're not going to expand. So interest rates have a major impact on the overall economy. It discourages consumer spending on durable goods and other commodities. So higher interest rates mean people will not buy the big ticket items. And higher interest rates may lead to general economic slowdown. Inflation. So inflation is a generalized, sustained trend of rising prices. So inflation has a so overall so rising prices, actually with inflation there's wage increases also. Salaries also increase with inflation. There's higher production cost also. It's not good for companies. They have to pay higher wages and they have to pay more for raw material, and so there's higher economic growth and higher employment, right? So if there's more inflation, then the standard of living for people will go down, and there's a reduction in the real value of investments. So overall, higher inflation results, people who are living on a fixed income, for example, pensioners, if there's inflation, if they're getting $1,500 a month, now inflation goes up 3%. They need to cut down some of their expenses because they won't have enough to pay all the bills, right? So if their grocery was costing them $100 and now their grocery is costing $125, so now they will have less standard of living, so they have to cut down on some of the things they buy. So that has a major impact on their spending. And then when spending is lower, that slows down the economy, right? Main thing driving the economy is consumer spending. More people buy items, the more companies have to produce more, and there's economic activity of production, raw material. It's all a cycle, right? So raw material coming in, factories producing, goods distribution, trucking, and then warehouses, all that is a cycle. And then the stores. So inflation we measure through CPI, like we just saw. CPI it tracks the retail price of a basket of goods. It overall takes a look at, for example, so in this case, usually it's 600 different items. So the CPI will calculate what is the value of these basket of goods. And so that is the purpose of the CPI. And the CPI in the current period is compared to base year to arrive at the inflation rate for the year. So CPI is compared to base year. So just like we saw before in the trend analysis, remember in the ratio we did the trend analysis. So CPI in one year is going to compare to the CPI in the other year, and we can see the overall trend. CPI and inflation. So overall CPI is used to measure inflation by calculating the sum of retail prices for a basket of goods and services that is representative of the typical Canadian household. So it is calculating the average of the prices. So like we said, they look at 600 different items, and the government monitors what is the price of these over time. Same way we did before, like if the current CPI is 130, and it was 120 before, what is the inflation rate? So we do, so 130, 120, the difference is 10, right? 10 is the difference. 10, and we divide it by 120 because 120 was the previous value. So we divide it by 120. Oh, I'm sorry, this should be times 100. This is a typo, so I need to fix that. So it's times 100. So when you times it by 100, then you will get your percentage. Okay, so in this way, we will calculate the percent. So times 100. Here we go. Okay. Yes. So then we get our calculation for the CPI. There we go. Okay, so 10 divided by 120 times 100 will give you 8.3%. And that is how we calculate CPI change. Any question on this?
No.
Okay, and then inflation. So yes, inflation. In inflation, we talk about the output gap and the negative output gap. So to understand that, I have this diagram here. Let's first take a look at this diagram. So this is over time. Okay, over time, what is the GDP? Now, the government wants the GDP to be growing. Let's suppose this line here is the trend growth, the target. What is the trend growth? That is, we want the GDP to grow at this, like this. But in reality, the real GDP is going to go up sometimes, it's going to go down sometimes, so it will be varying, right? Now, if the GDP is more than the normal, that is called a positive output gap. If it is below the trend, it's called a negative output gap. Okay, and same thing here, if you have an increase, it's a boom or a peak. Here you have a slowdown, here you have a recession, here you have a recovery. So this is how the GDP will be indicating the economy. And overall, so this, in this case, the two will talk about positive output and negative output. So negative output is when actual output is below the potential. So the companies have spare or excess capacity, and increased demand does not result in inflation. So more demand does not mean that there is more inflation. Overall, the negative output, so negative output is not good either, right? So you have a slowdown in the economy. And then positive output is also not good. Economy is operating above its potential. So here, the actual GDP is higher than the potential. It seems like it's good, it's positive, but not really. There's a strong demand for goods and services. And when companies operate above capacity, they can raise prices due to demand. You know, if there's more demand, just like iPhone, they can increase the prices to 1,000, 1,100, 1,200, 1,300. People will still buy it because there's demand, right? So the price of the products may be increased because of the demand. Companies sometimes try to control the demand by increasing price. So if there is demand, then you increase prices, then that way you can control. But that type of inflation, increase in price due to companies operating above capacity, that is known as demand pull inflation. Other times, there may be your raw material is expensive. If the raw material is expensive, then this results in cost push inflation. So scarcity of resources, that is the normal one usually, like, oh, if you can't get the raw material or the material is really expensive, then the price will go up, and that is cost push inflation. So these are two reasons why there is inflation, and so these are the underlying two types of inflation. In inflation, so there's disinflation and deflation. Disinflation means there's a decline at the rate that prices are going up. There's a decrease in the rate of inflation. So so suppose your inflation is going up 5%. Now it's going up 4%. Then it's going up 3%. So it's still going up, right? But it is slowing down. That is disinflation. Deflation is a negative. So you have -2, -3 inflation. So which means that actually items are getting cheaper. So it would be good, one day you buy grocery, it costs you 100, next it costs you 90, next it costs you 80. So that's good. Like you're happy that you have less prices, but it's not good for the retailers and the production and the factories. They need to charge less money. Their profit margin is going to be lower. So deflation is not good for the companies, but it's good for the consumers. And so if there's a lot of deflation, companies may actually become in negative. They may have lower profits, and then they may have trouble in their finances. Okay, next we talk about monetary policy and the bank rate. So monetary policy refers to regulation of the monetary supply, money supply, and available credit. So actually we're going to talk about two things here. One is monetary policy and the other is the fiscal policy. So two things we'll talk about. This is in the economy, what affects the economy. The government of Canada, they can control the economy with monetary policy. What is monetary policy? Three things the government can do. They can change the target for the overnight rate. That is the bank rate. That is like the prime rate. The government, they have a certain rate at which they will lend money to the best investors. So that is the overnight rate. Okay, there's the bank rate and the overnight rate. So the government may increase that rate, and that will be an indication of how the government wants the change to be. Cash management. The government prints the money, they deposit the money in the banks. They may draw down and they may redeposit. Drawdown is they may take the money out, and redeposit, they put the money back in. So every day a lot of money will be deposited into the banks. Sometimes they take out money from the banks. So there's drawdown and there's redeposits also. So Bank of Canada is known as the fiscal agent, and the Bank of Canada, obviously, they issue banknotes, they control the clearing system, and they're lender of last resort if any major companies are going to have a serious problem. So you might have heard the government has also provided a lot of support to automobile industry. So the Bank of Canada will manage that to give the loans or the payments for those from the government. So that is the Bank of Canada. They maintain they maintain the financial markets, and they conduct monetary policy. So what is fiscal policy? The government can manage the economy with fiscal policy, and this includes government or consumer spending. So the government manages how they will spend their money. For example, for infrastructure, what projects is the government going to undertake? That is one fiscal policy aspects that they will be managing. The other is taxes. So governments can increase taxes for income taxes, corporate taxes, taxes on our gas, all those taxes that we pay, they can change those. So if they increase the taxes or decrease the taxes, that is also fiscal policy. So keep that in mind, these two, the monetary policy, three main things: bank rate, cash management, and drawdown and redeposits. And under the fiscal policy is government spending and taxation. Any questions so far? So balance of payments, so this here, there's the current account and there's the capital and financial account. So all the money going into outside of Canada and inside Canada, of course, they keep track of it. Of course, there's some money which comes in cash, but that's why you have to declare if you bring in cash into the country. There is an account that keep track of how much money is inside Canada, which money may come through wire transfer from banks, or it may come through other ways for payments, etc. So current account and capital and financial account, two accounts they keep track of. Current account is for one-time payments, net payment of investment income, net transfers between countries, right? Um, so current account means like overall, here you have deficit, maybe there may be a shortfall, and so these are all captured in the, so those are captured to the capital account. The capital account is the flow of payment. So the main difference is that capital and financial account, this is for flow of payment. Anything regular, ongoing, that is flow of payment. That is, if you're getting payment every month from outside of Canada, for example, for interest payments, or every month the payment is coming in, that is recorded in the capital and financial account. If it is a one-time payment, it is recorded in the current account. Okay, so those are the two main differences there, and for the capital and current account. Okay, any question on this? So we're done with this also. Chapter number 2 and 3 are done. Any question on these?
No.
Okay. So their ability to bear the risk, they may decrease with age, they may increase with sophistication, they may look at clients' investment portfolio, right? So overall, the risk tolerance, it depends on if their family responsibilities are high or low, or overall personality. Some people, they don't want to lose money. Others are okay, they're willing to take a risk. People do risky sports also, risky things also. So it depends on their personality. The risk tolerance may be affected by their psychological characteristics, personal circumstances, financial aspects, investment knowledge, and also time horizon. So, so that also could be, risk tolerance can also be affected by it. Life cycle hypothesis. So as people go through various stages in their life, their goals, risk tolerance, financial. So they divide into 5 stages. So people are put in different stages, and each stage is different behavior or different ways they work. So early earning years, stage 1, they just started working. They're low income. They don't have a lot of responsibilities. They may not need life insurance at stage, although it is cheaper. They should get it here, but that is early earning years. Family commitment, they have a family, they have children, and if the income is low to moderate, you have a young family, they need liquidity, horizon tends to be short, and life insurance is a must. And asset allocation must reflect this lower risk tolerance. And then mature earning years, those are established in the career, as many liabilities are paid off, good disposable income, they have the highest income of their lives, highest tax bracket also. Teenagers are very expensive, so their focus is on retirement here at this stage. And so they are open to investing in stocks at this stage in mature earning years. And in stage 4, they're nearing retirement. They approach their retirement age. They're empty nesters, children grown up and they start moving out, and they're more concerned about, will we have enough? And risk tolerance tends to decrease during this time, and they have a high tax bracket, and they shift to lower risk equity. So usually at this stage, their risk tolerance goes down near retirement. And when they're retired, they must live on their savings. They should not run out of savings. And estate building, asset allocation. So yeah, so this is the financial planning pyramid. When you're talking to clients, they have to talk to them like, first base of any financial planning is insurance. Have insurance, because if a person becomes sick or dies, it's going to be a severe impact on their financial situation of their family. They should have a will, because otherwise the money will be divided according to the government's rules. So they should have a will. They should have a house that's forced saving, and some savings, also RSP, emergency fund. They should have debt elimination also. And then they should start investing in some conservative types of investment, like bonds. debenture, GICs, some mutual funds which are less risky, the conservative ones, those ones they can put into, and then they can do moderate mutual funds and stocks, and then more aggressive type of investments, which are precious metals, gold, art, and IPOs. Those are more aggressive types of investments. Okay, so that was it for this chapter. Any question on this? Yeah, it's a little bit boring chapter, I think. Yeah.
No, I'm good.
Okay. Chapter 5 is more about different types of clients. It's more theory, and I would say just like it's just some may be true, some is not true. It's just behavior of clients. Why do they behave as they do about investments? If prices are going down or up, some people will buy, some people will sell. So overall, some people are risk averse, those who cannot tolerate risk. Others are risk tolerant, so most of them are risk averse. So behavioral finance, we have, so for example, there's something called like January effect, less people buying in January because in December they're spending on Christmas and other spending stuff. In January they'll stop buying and they'll start saving or something like that. So that's like a January effect. Standard finance is how investors should behave, and behavioral is overall looking at how do people think about the economy. So rational means people, they do analysis, they have data, they gather the information, they make decisions based on data. That's a financial decision based on rational. For behavioral finance, we combine psychology and economics to explain why and how investors act and how that behavior affects the financial markets. So in the investment behavior, there's personal beliefs or biases. People may have their own thought process, and that may affect their decisions. Their decisions may or may not be positive, may not be logical. And then there's standard finance grounds. It's assumption and idealized financial behavior. Okay, what are biases? Is like preferences or more, they're more inclined towards something. That's a bias, right? So there's two types. There's cognitive bias and there's emotional bias. Cognitive bias is based on their thinking process, but their thinking is wrong. So that's a cognitive bias. They like something because they think it's good for them, but it's really not good. So that's a cognitive bias. Emotional is impulse or intuition. So they don't have any thought process, just, oh, I like this, I don't like this. That's emotional bias. So it's not really based on their thought process. Cognitive biases is overconfidence, unwarranted faith in one's intuitive reasoning, judgments, and cognitive abilities, and failure to learn from mistakes. Purchasing investments based on the gut feelings. So these are examples of cognitive biases. So the overconfidence is they're always sure of themselves that I always make the right decisions, I always make the right investments. So that is overconfidence. Representativeness is people develop internal systems for classifying objectives and thoughts and may rely on best fit approach to new information. So so if classification reflex is wrong, it produces incorrect understanding of new elements. So representativeness is they may think about what is the best answer to it, so they will just take that as the decision. So under cognitive biases, we have cognitive dissonance and availability. So this is, again, they're thinking about something and they don't understand, they don't agree on what is the best for them, and they will work it out through their own thought process. So they try to convince themselves that yes, what I'm doing is correct, and so they will work based on that objective, that it is good for me, and so I'm going to be doing this, right? So they try to convince themselves. Um, Availability is familiar, understandable process, and yes. So, for example, investor chooses a mutual fund as a result of advertising. So because they say, "Oh, this is not a good one. I never heard of this. I never, I never um, like this is I don't know what to. I've never heard of this. I'm not going to invest in it." So that's availability. I've heard of this company or this investment. So that's based on availability. Emotional biasness, there's endowment and there's loss aversion. Endowment is there's more value placed in assets owned. So they may think I want to keep holding onto this on this security rather than trading it for better opportunity. Um, and so that is loss aversion. So that is endowment, and then loss aversion is so loss aversion is possibility of loss is twice as a motivator as the possibility to make a gain. For example, even if they're losing money, they don't want to sell because they think that if I sell, I'm just going to lose more money, and so I might as well wait. It might go back up. So that's a loss aversion. Regret aversion, fear of making a bad decision. They don't want to they don't want to buy, they don't want to sell because they don't want to make a wrong decision. They say, okay, I'll have to think about it. That's a regret aversion, that they're not sure, right? So that's a regret aversion. Status quo, they just want to keep this thing the same. They don't want to make changes. So sometimes they are just comfortable. They have a bond. They always invest in bonds. So they never invested in stocks. So they don't want to put money there because they don't want to try something new. So that is status quo. Gender and behavioral finance. So typically, like, this may not be true, but may be true. I don't know. It's theory that men and women are susceptible. Men are more, they have more cognitive, overconfidence bias, loss aversion bias, availability bias. They're more affected by advertising and cognitive dissonance bias. Whereas women have more emotional decisions. They like to keep their status the same. They have representative bias, and they have regret aversion bias. So this is just observed people. I guess they're observing people doing that. So it's basically, when you're doing the asset allocation, you need to see what are the client's thought process, what is their behavior, and they may be so there are moderate bias and less wealthy clients, adaptive bias and wealthier ones, and there's moderate cognitive bias. So that's basically, I mean, this one a chapter is really just, I don't know, it doesn't make too much sense. I think it's more like theory. I don't know, did you see any questions on that in the exam?
Yes, we did actually. There is like probably
Yeah.
3 or 4 questions on
Yeah.
that.
Okay.
Especially the one on the men and women, because usually because men are more cognitive, they always ask which how they put it. They say which for men give us they like say which of the biases is an emotional bias for the men,
Right.
because so they I think I've seen a question like that before.
Mm.
I know there is a question, 2, 3 questions where they put where you have to actually say which bias